not sure how the previous 3 went, but I just want to be better. So I'll tell you how we did the previous 3, and if it doesn't work for you, tell me, and if it does, we'll go with it. So I did like a 1-minute overview of Zelkova, my fund. We then did like 30 seconds about each of your companies, so I had some frame of reference, and then Q&A from there. We can do it any way you like, but that's kind of how we came up with it. So we'll start there, and then the more questions the better. Zelkova, early stage fund, primarily B2B SaaS. It's about 70% of what we do. The other 30% is stuff that really just piques our interest. Been around for 8 years, 65 investments to date. Fund 1, very strong returns, 15 plus positive exits already in that fund, 14, 15 active companies still, and some pretty large, given they're now 6, 7 years old. Fund 2, relatively early, about 12, 13 companies. Primarily B2B SaaS, as I mentioned. We invest early, follow on heavily. So average check size, initial check size last year was 175,000. We reserve 3 times after follow-on. So typically what we'll do is companies will be raising a seed round of about $1 million, give or take. We'll put 175 to 200 in. They'll then need to do a seed extension for a lot of reasons. They're overconfident in what they can really do on $1 million. The market has actually shifted on what you need to get to your Series A. So that's when we'll bridge them. And we'll put 400,000 to 500,000 in, and that's where we really step up. And then we'll do a smaller amount within the Series A, and that's typically our investing thesis.
So I'm from ParlayMe. My name is January, and we are a curated Angelus list, if you will.
Okay.
We believe that 70% of what you invest in is the person, the founder, and 30 to 40% the business model. So we're about creating content around founders and parlaying them. And then we have a network and a community where we're actually going to matchmake investors with startups and an equity fund as well.
Got it. So what dirty secrets about venture capital and startups you guys want to know?
What makes you so entrepreneur? Just joking.
We say it's 97% people, 2% market,
Right.
2% market and 1% product. That's probably a little tongue in cheek, but it's directionally accurate to what we look for. It's all about people at our stage.
Thank you. Can you say that to camera again? Just joking. That's great.
It's all about the people.
Yes,
yeah.
Absolutely.
I've never regretted an investment until I realized I invested in someone who didn't have the kind of same morals or views that I had, or and obviously I think my morals and views are the best. But I think most people would feel the same thing. So those are the only real mistakes I think seed investors can make, is when you back people that you didn't really want to back.
To that point, I guess finding ideas or startups that are in your vertical of field. How do you go about finding them? Are you part of any groups? Are there any platforms? How do you go about other than going through your inbox daily? How do you find?
Yeah. So we started the fund in 2007, and the world was a very different place. New York was a very different place, I should say. It was incredibly difficult to raise capital. There were only a handful of early stage funds. I say early stage funds because the seed fund term hadn't been coined yet. So it was pretty easy back then to find companies because there were so few investors, and we were all very collaborative. We were lucky we started then because we built our brand, we built our reputation in the market. So now deal flow comes from everywhere. Where investments come from are typically a few places. Existing portfolio company CEOs. So introductions from CEOs is incredibly valuable. Incubators, we're very close with several incubators. We're investors in Techstars, we're investors in Amplify. Other funds, we are LPs in other funds, but more importantly, we're partners with other funds and we share deals. Those are kind of the 3 largest sources of investments. Typically then the question is, well, how does someone get in front of you? I would say cold email is the last place, right? So kind of, the best being an existing CEO, the worst being a cold email. Well, what if you don't have that connection? I'd say actually social media. Start to engage with investors online. We tend to all have pretty big egos, so we like that stuff, right? Like, read the blog posts, comment, share, and that will help to build at least an awareness of who you are in front of us as investors. So what keeps you guys up at night?
We just have to find maybe some strategic partners to cooperate them and to help us to share opinions and maybe give some feedbacks, and maybe if they want, it will be really achievable for us to find people who would like to test our device.
Kind of curate, it's artificial intelligence for marketing. So we can do massively scalable but individually targeted marketing.
Okay.
So we've built our algorithms on essentially all public data, Facebook, Instagram, Twitter, everything.
Okay.
And using that we can predict consumption. So where people are consuming, how they're consuming it, what factors into the consumption, what influences the consumption, and then what times they're consuming.
Sure. Okay.
So we've done, we have 5 POCs out now. Essentially it runs the gamut of retail CPG. And then we have, we're partnering with XLive to actually, which is an events company, to track human migration during a live event. So pre-event, during the event, and post-event impact.
Very cool. Good.
Hi, so my name is Harry Berger, and I'm a junior at Tulane.
Okay.
And this summer interning at WeWork, and I have a mobile app tech startup, and it is FrameShare. And what FrameShare lets you do is really enrich photos collaboratively, as opposed to many photos you see, whether it's on a phone or a computer, even a physical painting at a museum. The perception of the photo is all passive. There's no response you could get on the actual photo itself. So.
Hi Jerome, my name is Oksana. I'm a co-founder of CoWork. We developed a special device for elderly people to motivate to do follow health lifestyle, measure their vital signs such as respiratory, temperature, ECG, heart rate, and etc. And also with special mobile app, it will send instant push notifications to their relatives, to their grandchildren, for example, or their daughter, son, doesn't matter. And so you will get push notifications about how your relatives feel at this moment, if they are okay, and you can also cheer up if they are doing well. And so it has also sociable side to always keep in touch with your family and to communicate with them.
So we want to see diversity among client sizing. So we have 2 companies actually that are selling to financial services right now, and they're trying to sell to the big banks, right? Goldman Sachs, Merrill, Morgan, and those are amazing customers, right? But those are customers that are going to take us years before we see any real revenue function. So we need to go is downstream, right? Who are the smaller banks, smaller fintech firms that can make decisions in 60, 90 days, right? Not 6 months, 12 months. And get those on board. Because the other thing is then from a fundraising perspective, if you've got all these kind of whales that you're trying to get in the boat, and until you get them, your revenue is going to be next to zero, or stagnant. Right, and yeah, it'll jump, but then it'll be okay, well, how big is this market? But if you got a bunch of little customers, you got diversification. If you lose some, it's not the end of the world. So I think trying to go after some smaller companies also will be helpful. We tend to try to invest. If you look at our portfolio of companies, all of them are companies that we can add value and help on and understand. So I think from an investor standpoint, and advisors, you got to find people who have invested in medical technologies before, who've started them. Boston's probably a great place, but even New Jersey, right? You've got all the pharmaceutical companies in Jersey, so there should be enough people around this area that you can get to them that can help you. We try to read all the cold emails, but we can't, right? And it's astonishing how many come in. Bankers are constantly sending us deals, and it's not that we're being rude, it's just our priorities are existing companies, come first, Companies that we are actively in the closing process for or going to definitely be investing come second. Third comes new deal flow, and that's obviously broken out among the source it's coming in from. So like of the priority list, like, you know, cold emails pretty low on the list.
And in regards to like platforms that are popping up, like equity crowdfunding, all these things, do you utilize any of those? Do they kind of hit your radar? Or that
I mean, we were early users of Angelus. You know, obviously Angelus has grown quite a bit over the past few years, but we were early users of Angelus. I mean, the challenge with angel investors is they don't always have the ability to follow on, and they don't always have the they have biased decision making, right? Because it's, do I go on vacation? Do I invest in startup? Right? Like that's legitimate, right? So the challenge with angel investors is you don't always get that follow-on ability. Whereas for institutional investors, at least they have the pockets to do it. Doesn't necessarily mean you can get the check, but they have the ability to do it. And there's value to that. You know, tell any company that needs a bridge round, right? That didn't have institutional investors. Would they have taken a little bit lower valuation to get institutional investors so they had this bridge round? 100%. You know, so I think that's actually one of the most important questions to ask right now in this environment is what is follow-on capacity and how often do you follow on? Because it's just getting harder and harder to raise follow-on capital. The more follow-on, even from existing investors, the more follow-on you have, the more leverage you'll have and to get at least fairer terms. Versus if you're dependent on one or two investors, like that's not a position you want to be in. Trust me, we've had to do it. It sucks. I don't like having to put in some of the terms and structures that we have to put in. But if we're the only people who want to step up, damn right, we're going to protect our own interests and we're going to care about our interests. If everyone wants to do this as a community, we're not going to be unfair, but it's going to be, just like happens to us. I mean, it's just kind of the nature of the beast. And the entrepreneurs get it. They're like, look, you're the only one who stood up. Yeah, I want to make sure you do the best.
I wanted everything I never had, like the love that comes with love. I wore envy and I hated that, but I survived. I don't want it.
My name is Jerome Wong. I have an angel network that's about 40 odd people. Half high school friends from Bronx Science, half from Wall Street, around the world. After that, the decay is kind of exponential with regard to trust. Things we invest in is pretty wide. We have software companies, superconductor companies, drone companies, soil conditioning companies for farming, medical device, airline seats. Yeah, so typical low-cost carrier is 3x3. We have a patent for design where the middle seat is recessed a little bit and a little bit lower. So when you're plane and deplane, the aisle seat goes on top of the center seats. So it's faster, you save a little money with regard to less time, sucking up fuel as you plane and deplane.
Say that again.
So aisle seats slides on top of the center seats when you plane and deplane. Get on off faster.
Oh.
Okay. I didn't understand enough with regard to my view now about what it takes to people to change behaviors with regard to their apps or whatever whatever software they use. And that's really come. I say that's the biggest lesson. And I still see a lot because I'll look at it, but doesn't mean I'm going to invest. Just to see maybe there's some magic diamond in the rough out there, just to be open-minded about it. I won't close it out, but generally I can't find something compelling enough to me that it would, that I'm comfortable enough doing that. If you're sitting here in Silicon Valley and you depend on the portfolio effect that, okay, I'm not sure, but I have enough one-on-one, I'm okay, but because we're not specialized, and maybe that's a negative, maybe it's not, just the way we run things, or stuff that we post. the reality is there's a lot of luck involved. I'm sorry, that's the real world.
Yeah.
Happy to be the right place, right time, and that's great. If not, then it wasn't your time.
And how much do you feel it comes down to the founder? Because at ParlayMe, we really focus on the founders, like creating content around the people behind the brand. How much do you think they are involved in the success of their brand? Or do you think some products doesn't matter if you never hear or see the founder? You just like, because there's a balance of, that PR spotlight and not.
So people want to believe that there's formulas for things. People like order in the world. Because if you don't have order, you have chaos. So the question is always causality. Yeah, you've seen enough books and research that, for example, In Search of Excellence is always the one that, I'm sorry to pick on that book. But it's okay, look at these great companies. Okay. Massive survivorship bias with regard to saying that they succeeded, ergo what they did caused it to succeed. Go 10 years after the book comes out and see what happened to these companies. The Kodaks of the world, the HPs of the world, all of some of the sheens worn off, right? So the factors for success is very hard because it's a very sparse matrix. There's a great book called Why Most Things Fail by a British scientist. And what it talks about is, whether it's a biological system or a company or most things actually fail. So there's a school of thought that avoiding failure as a way to get success is maybe a better way than trying to find the rules for success. It's a little bit tongue-in-cheek, but you kind of get that. It's kind of interesting because you have more data to go off of because most things fail.
Right. Yeah, if you look at these success models and try to build just towards that.
It's a massive survivorship bias. The one thing that all entrepreneurs ask is, okay, what do you guys look for? Because it's my money, it's very different than if I was managing someone else's money. So, in reality, and maybe people don't articulate it the right way, but because it's my money, it means a lot to me. The idea has to resonate with me for some personal or professional reason, something I've experienced through my life where I say, hey, this makes sense to me. If I was managing someone else's money, it's not quite that high a bar, honestly. Because if you don't put the money to work, you lose the money and then you gotta try to raise more money. So that's just the reality of it. When you look at your product, you sit there and say, okay, what change of behavior does your product require? If it requires a change in behavior, the question you should ask yourself, am I providing enough value added and differentiating stuff to make someone make that change? And it's hard to answer that honestly. It's like, of course, this is your baby, it's special, why wouldn't anyone love this? And that's a hard thing to do. How compelling is it really? Resistance clothing. So compression pants on when people work out, but they put in resistance panels and straps, so every time you're moving, you're fighting some resistance.
Oh, okay, for more exercise.
So exactly, so you're burning more calories for the same amount of time you're working out. I mean, there are a bunch of guys that are wearing it that were the Olympics and track and field. And some NFL guys. We have Patrick McEnroe as a spokesperson for that. I generally try to avoid stuff which requires building a brand. So most apparel or food, it's just very hard to build a brand. This one has some functional component which makes it kind of different, which is interesting, which once I tell people, they get it. So this is interesting, and that's the kind of stuff I look for. I'm not very bright, so I'm trying to find stuff that doesn't take much brains on my side to kind of evaluate. But if you sit there and look at pharmaceuticals, for example, you got to be an expert in your field. Okay, you can't just sit there and bet on your drug. I mean, even medical devices, like I said, we have one which is needleless injection. It just uses air pressure and spring power.
Oh wow.
Okay. It's for vaccines. Colorado, and there's a lot of stuff coming out of Colorado. So he gets involved. We hear things that way. I get involved with. I've worked in 10 companies in 3 continents. So people are aware I've been doing this for a while anyway. So once they hear a little bit, so some of the ideas come from some of the other investors.
Right.
They hear about that. I deal with some of the schools, like Columbia Venture Partners, which is the tech transfer office there. Tufts has theirs. I get involved with some of the green tech things. So I get invited to some of the pitch days for that. So sourcing ideas is not hard.
Okay.
So if it's not smart money that we can get involved with, we won't touch your deal.
The wind don't change, and nothing in the ground can ever cool. No hope, just lies, and you're taught to cry in your pillow. But I'll survive.